A financial reckoning is rippling across Florida's condominium market, erasing years of paper gains and trapping homeowners in a vortex of collapsing values and exploding costs. This is not a modest correction but a full-scale structural reset, driven by a confluence of economic forces that have shattered the state's foundational promise of affordable, sun-drenched living. Data compiled from market analyses and real estate transcripts reveals a market in distress. From the Gulf Coast to the Atlantic, and deep into inland cities, median condo prices have plummeted by 22% to 32% from their 2022 peaks. The downturn is characterized not by a lack of interest, but by a fundamental breakdown in affordability and confidence. The tripartite crisis: costs, regulation, and sentiment. The collapse is underpinned by three interconnected crises. 1. Hyperinflation in ownership costs. The carrying cost of a Florida condo has become prohibitive. Insurance premiums have tripled since 2020, now routinely exceeding $9,000 annually in coastal areas and reaching as high as $12,000 in luxury markets like West Palm Beach and Aventura. Simultaneously, Homeowners Association (HOA) fees have exploded, often doubling to between $800 and $1,200 per month. These fixed costs, compounded by 7% mortgage rates, have rendered monthly ownership expenses 40 to 50% higher than just 2 years ago, pricing out both local residents and out-of-state investors. 2. Regulatory and structural aftermath. The 2021 Surfside tragedy continues to reshape the market. Florida's new structural inspection and reserve funding laws are forcing massive, unbudgeted special assessments on condo owners, often ranging from $20,000 to over $60,000 per unit. These mandates are causing lenders to blacklist older buildings, drastically shrinking the pool of qualified buyers and leaving associations scrambling to cover soaring bills for maintenance and repairs. 3. The investor flight and Airbnb bust. The short-term rental gold rush has ended. Markets once dominated by investors, such as Orlando, Tampa, and Cape Coral, are now oversaturated. Airbnb occupancy rates have crashed below 50 to 55%, with nightly rates down 15 to 20%. This has eliminated the rental yield that once justified investor purchases, leading to a flood of inventory as these units are dumped back onto the market. Inventory levels have surged by 60% to 95% year-over-year in the hardest-hit cities, creating a traffic jam of desperate sellers. Case studies in the downturn. Pensacola, ground zero leading the collapse with a 31% price plunge. Pensacola exemplifies the shattered middle-class dream. Median condo prices have fallen from $310,000 to $215,000, with monthly costs now exceeding $2,200 in a city with a median income of just $60,000. Sarasota and Bradenton, the Gulf Coast retreat. These once booming retirement havens have seen values drop 30%. Inventory is up 65 to 70%, and retirees on fixed incomes are being crushed by insurance bills that have jumped from $3,000 to over $9,000. Tampa, the confidence crisis. Despite strong job growth, Tampa's market is reeling. Inventory has ballooned 85% to 4,000 listings. The psychological shift is palpable. Buyers are Northwest longer asking about square footage, but about insurance premiums and pending assessments. Aventura, luxury's limits proving that no market is immune. This affluent Miami-Dade enclave has seen a 27% price drop. High-end international buyers are retreating as carrying costs surpass potential returns, and $40,000 special assessments become commonplace. The human and economic toll. Behind the data are stories of financial distress. Retirees watch their savings evaporate and face the impossible choice of paying five-figure assessments or walking away. Small-time investors who bought during the pandemic are bleeding cash on properties that can no longer break even on rent. The ripple effects are stifling local economies, with developers stalling new projects, contractors seeing slowed business, and lenders tightening credit standards across the board. 2026 forecast, a year of reckoning and resets. The trajectory for the remainder of 2025 points not toward a rapid recovery, but a protracted and painful recalibration. Prices will continue to face downward pressure as high inventory and forced sales outweigh demand. Further declines of 5 to 10% are likely before a bottom is found. The cash buyer will be king. With financing increasingly difficult to secure for condos, the market will bifurcate, with deep-pocketed investors able to extract steep discounts while traditional buyers remain sidelined. The insurance and regulatory crisis will intensify. As more buildings face their first milestone structural inspections, a new wave of multi-million-dollar repair projects and associated assessments will be unveiled, triggering another round of financial distress and value reassessments. A fundamental repricing of risk is underway. Florida's condo market is shedding its speculative, growth-at-all-costs model and being forced to confront the true, escalating cost of climate risk, aging infrastructure, and regulatory compliance. In conclusion, the Florida condo dream has not merely cooled, it has been fundamentally altered. The market is undergoing a structural reset where affordability, not allure, is the primary driver. For 2025, the storm clouds of cost, regulation, and oversupply show no sign of parting, signaling a year where the financial foundations of paradise will be tested more severely than ever before.